Gunjan, really eventful week to say the least. I think really one of the standout features of this is the intensity of the volatility, perhaps particularly in bonds and relatedly in bank stocks, which, if nothing else, suggests that people were wrong-footed coming into this, and/or I guess the range of possibilities for what could break from here is pretty extreme, to say the least.
Absolutely, Mike. I didn't think anything could outshine the volatility we've seen in stocks like First Republic, some of these other regional banks, but the move in the bond market has been eye-popping, and that's what traders have been talking to me about all week long. The two-year Treasury yield has logged some of its biggest declines since 1987. I think that tells you everything you need to know about just the amount of uncertainty out there, how people are positioning for the Fed next week and over the next few months, and just how much the world and the economy has changed in 1 week alone.
I was seeing some reporting on these statistical models that suggest how markets ought to trade and what moves represent a true extreme. And the two-year Treasury yield moves this week by the models should not have happened except once every 50 million years. So it probably tells you something's wrong about the models, as well as telling you just exactly how wild the moves have been. And when we have this type of action, I think the instinct is to wonder just who ended up on the wrong side of it, just what sorts of investors, whether we're going to see losses surface in one category style of hedge fund or something like that.
That's right, Mike. And I think a lot of the traders who were caught wrong-footed, and believe me, many were, a lot of traders were very, very bearish heading into this week's move. A lot of them were computer-driven funds, quant funds, CTAs, who had really bet against treasuries heading into this year. And honestly, who can blame them? Think about the messaging that we've gotten from the Fed in terms of further interest rate hikes, and a lot of people were positioned for that. So what I've been hearing is that this huge move in the 2-year and 10-year, the types of moves that we have not seen in decades, they were driven, of course, by a flight to safety that benefited assets like gold as well, but also this really wrong-footed positioning, as well as poor liquidity in the markets. And all these different forces were kind of coming together to help drive this incredibly violent move in the bond market.
Yeah, the really patchy liquidity has absolutely been very evident here too. And I know you sort of track a lot of retail trading flows as well. We have an options expiration of quarterly one, big volumes today, and an index rebalancing, things like that. But we've also seen yet again a rekindling of some excitement in some of the biggest names, of the NASDAQ, let's say. You've seen the runs in NVIDIA, in Microsoft. That muscle memory seems to have kicked in again.
I think muscle memory is exactly the right term. I mean, it's so reflexive. Anytime you get a move lower in yields, higher in yields, it seems like the NASDAQ kind of moves in tandem. And it's pretty remarkable to see that outperformance this week. It's up, 4-5%. And it reminds me of 2020 when tech kind of became the safe haven trade. It was like, oh, everything's dropping. Let me buy Apple. Let me buy NVIDIA. And that seems to be on display here. I think one thing to watch out for is when I speak with individual investors, when I speak with some of these retail brokerages, it does seem like there's some fatigue in terms of buying the dip. Last year we saw people pile in during some of that volatility, and I've been hearing that people are just getting tired of doing that. And I think especially weeks like this make it tougher to justify sometimes, just because there's so much uncertainty ahead.
Absolutely. Hey, we're basically more than 2 weeks past the actual speculative peak in a lot of those areas of the market, February of 2021. Gunjan, great to speak with you. Thanks very much.